accounting. Yeah. So without wasting time, I hand over it to Jailesh. Jailesh, over to you.
Thank you, Preeti, for the introduction. So good afternoon to one and all. Thank you everyone for joining this webinar. So today we are conducting this webinar on the very basics of option. Last time we conducted options on the various strategies. So on certain request, we thought to again run you through the basics of the plain options and all. And then probably we can, again, if required, do some webinars on option strategies at later stages. So in this particular option, we will run you through features of plain vanilla options. How are they different from forwards? What are the parameters, or rather say, what are the factors that affect option premium, option pricing and all? What are the rewards and risks involved in those basic options? And then in the second half, we will run you through various examples of each of the 4 basic options. So, and then we'll have a Q&A session where you can put in your Q&A at the end of the session, and we'll be happy to answer those. Thank you. So I'll start with my presentation now. So basically, why would you do an option rather than just doing a forward? So options provide you participation in case of favorable movement. So we'll go through those points in the next slide. So basically, in case of forwards, you get locked to certain rates, while in option, it will allow you the flexibility if there's a favorable movement in the currency where you are doing options. So this is all that also allows you that you're not locked near the top of the market. Generally, if suppose you do an forward and rupee goes down, if you do as an importer, you book a forward and your rupee appreciates, then you might get locked at the rate. But option will provide you that flexibility where even if it moves in your favor, you can access the markets at lower rates. So this way, and this also provides you with a hedge in case it moves on the higher side for an importer, say from 82 to 83. Then buy calls or options or other combination of option can provide you hedging also against those movements. So option will provide you in a way, we can say, provides you with best of the both worlds, but it has a cost. So we'll run you through the various things involved now. So on a basic, primarily, if we say what is an option, so a contract which provides buyer right, but not the obligation to buy or sell a specific asset at a specific price on or before any time prior to a specific date. So in this case, options basically provide you the right. So it means you have the right whether you want to exercise the option or you don't want to exercise the option. While in case of forward, you will always have an obligation. Once you have booked a forward contract, you have to adhere to that contract. You have to compulsory utilize or cancel the contract. But here it is your right whether you want to exercise the option or not exercise the option. Specific asset means in this case, when we talk about Forex, we talk about the currencies involved. It can be dollar, rupee, euro, GBP, anything. So those currencies can be bought or sold through options and at a specific price. Now, specific price herein means in case of forward, if you have to book a forward, you will have a spot, which is dollar rupee rate or any rate, which is prevailing in the market. And that you have to take in, that spot will be applicable for everyone and there will be a premium added to it. But in this case, option, you don't need to hedge it on that particular spot. You can decide the strike price, what it is called as, based on your requirement. And of course, based on the strike price, what you choose, the option premium will change, but it is up to you what rate you want to protect. That's why it is called a specific price. Now, these options can be exercised on or before any time prior to specific date, which is the maturity date if you have booked an option. So these are the different options. We'll come to that. In India, it is not allowed basically to exercise this option prior to date, but outside India, there are many places where it is allowed to be exercised even before the maturity date. So moving ahead, there are 2 types of options. Call and put. We'll go into the further description of these 2 options. So options, this particular slide have been also run through in the previous webinars. So option is basically like buying an insurance. So once you buy an insurance, you forget. So you have paid the premium. Now, if the uncertainty that occurs, actually, the actual event happens, then this option will provide you the insurance against that. And if it moves in your favor, then you can just leave the option. Your premium is gone, but you don't need to exercise the option. That's why it is called as, you can compare it to buying an insurance. Here you need to pay the premium upfront, because as in case of insurance, you have to pay premium before buying the insurance. Similarly, in case of options, you need to pay the premium upfront here. As we said earlier, it will provide protection against adverse movements and also provide participation in case of favorable movements. Vanilla options are generally expensive because they provide you best of both worlds, we can say, because it is protecting your risk and also providing you opportunity to capture the favorable movements. There are options are also traded on NSE and in addition to OTC market. OTC is your bank. When you're dealing with bank, you can you can take these options through banks, or you can also trade it on NSE. So these are the basic features of option. Now, when we move, what are the basic type of options? So call and put are the basic type of options. Call option is basically generally used by importers. So call option gives the buyer. So when you buy a call option, it is a buy call if you do, it provides you the right to buy the underlying asset at a predetermined price. So if you're buying that option, you have a right here. You don't have an obligation to use that option. And so whenever the buyer of the call will exercise his right, that is, he decides to buy the underlying asset. Means if you have done a buy call on a dollar rupee at, say, example, 82. So when you want to exercise that at 82, if rupee has gone to 83, then whoever is the seller of the option, who has done a sell call, he will be obliged to sell that dollar rupee at that rate at 82 to you, even though market is 83. So you get dollar rupee at a lower rate of 82. And if it goes below 82, say 81, 80, then you have a right. So you don't need to exercise that option. You can just forget the premium and buy dollars from the market at 80 or 81 rate. So that's the call option. And we'll run you through the examples again. Put option gives the buyer the right to sell. So as an exporter, when you want to sell dollars, you can do a buy put, where it will provide you a right to sell at a specific rate and a predetermined price. Basically, whatever rate you want, whatever currency amount you want, you can do a buy put there, and you can exercise the right. So whenever you exercise the right, the seller of the put option will have an obligation, while you will only have the right. Whether you want to use it or not, that is completely your decision there. Now the basic about option is, as I said, you need to pay the upfront premium to buy protection. And if it is just to fix a rate for future, means if you don't want a scenario where you want to take the advantage of the favorable movement, then you may just go ahead with the plain forward booking and you get locked at those rates. But if you are willing to pay the premium, extra premium, that it will insure you against the adverse movement, but also provide you a solution where you can access the market rates where favorable movements happen. So if it moves in your favor, then you access the market rates. If it goes against, you use the option. So in those scenarios, if you are willing to pay the premium, then options are a better better than the forwards in those cases. Now again, the view of the market will also give an idea whether the basic rationale behind structure we want to use, as in whether if you feel that market, your view is basically that it will just go one way up or it will just keep depreciating, and you are an importer, then you may just want to book a forward. And otherwise, if you're an exporter and if you feel rupee is just going to one way appreciate, you might just book a forward and forget it. But if your view is that it can move large, but it may move either way, and there is some event like a general election or a budget or some uncertain event is going to happen there. So on those cases, in those dates, basically you can look to do options, which will provide you a better flexibility on either side. So this is a basic comparison of forward versus option. Forward may you have a contractual obligation. So whenever you do a forward contract, it's a legal binding contract. So either you cancel it or you use it. But in case of option, it is your choice whether you want to utilize it or not. In case of forward, if you are an importer, you pay the premiums, while in case of export, you receive the premium. But while on the other side, if we think of options, it is always you have to pay the premium if you are buying the options. If you are selling the options, you receive the premium. So it depends on what you are doing in that option. But generally, if you are trying to just log the rates by doing a buy call or buy put, then you will have to pay the premium. And these premiums are paid upfront. While in case of forward, it will be captured in your rate, and the payment, it will happen on the maturity date of the option. Now, again, as I said earlier, in forwards, they are plain vanilla contracts. So whatever is the spot, say suppose you want to book a 3-month forward. So the spot rate plus 3-month premium will be added, and that will be your rate for 3-month forward rate. It's a plain vanilla. You can't do anything because market is at that rate. You have to use that rate. But in case of option, you can customize the contract whichever way you want. So even if your spot rate is trading at 82.75 as today, you can do an option for 83 or 82.50 or 82, whichever way you want to look at. The premium will change accordingly, but it is customizable. Customization is available there. Now, in case of forward, as we say, if we are already logged at a certain rate, then and rupee moves in your favor, then that's an opportunity lost for you. While option will provide you flexibility on both the side. So this is the basic comparison of forward and option. So this you need to know when you have to decide whether I should go for a forward or I should go for an option. Now, the base options, both the call and put options, you can do it both ways. You can buy a call, you can sell a call, you can buy a put, sell a put, sell a put. So the concept for each option is like if you do a buy call, it means you have a right to buy, which is the first one. And if you have a sell call, if you've done a sell call, it means you have an obligation to sell, because the other person has a right to buy. So the seller of the call option will have an obligation to sell. Now coming to put option, if you are doing a buy put, then you have a right to sell, and the other counterparty who has done the sell put, he will be obliged to buy whenever the buyer of the option exercises his right. So suppose if you have done a buy put and you want to exercise your option on the maturity, the seller of the option will have to oblige and he will buy the dollars from you. So this is the basic combinations which will work: buy put, buy call, sell put, sell call. Now, when you are dealing with bank or NSE, you need to know certain terminologies which are different in case of forward and in case of options. Now, in case of forward, you will just need to know what is my spot rate and what is the forward premium. But here, either if you're doing it with a bank or if you're doing on the exchange, they will ask you what is the strike rate, at what rate you want to do. So it is a predetermined price at which buyer has right to buy. So you decide whether you want to lock it at which rate. You want to do a buy call at the current rate, or you want to do it on the rate above this or below this. So that is the strike price which you need to define. So suppose market is at 80 to 75 and you think, okay, I don't want to protect 80 to 75, but even if I am able to protect 83 as an importer, then I'll do a plain buy call at 83. So by doing a buy call at 83, I also save a premium a bit, but also it provides me a protection beyond 83 level. So now 83 is called as my strike price there. While my spot rate was 80 to 75, but I decided to do the option at 83. So 83 is the strike price in this case. So every option you need to decide what strike price you want to do, the option, and then the second thing will be the premium. So depending on the strike price, what you want to capture in the market, your premium will change. Whenever you are, in case of forward, as we said, you are just probably buying or selling, then you are either paying in case of import and export, you are receiving. But here you have to pay the premium and you will be paying it upfront. Now your option premium, whatever you are going to pay, will basically consist of two values: intrinsic value and the time value. So suppose if you are doing an option for a longer maturity, so time value increases. So if you are doing it for September, or if you do it for December. So of course, December maturity option will be costlier. So because so it is a premium is combination of two values, in time value, and the intrinsic value is basically whatever is the rate today if you want to hedge, and at what rate you have taken the strike rate. So the difference between those two will be your intrinsic value. So as far you go from your current rate, the premium will change accordingly, and the maturity as far it goes from the today's day, your premium will increase accordingly. Now coming to the European options and American option, when initially I said that it can be exercised either before the due date or on the due date. So European option is the one where it can be exercised only on the due date of the contract. So suppose if you've done a buy call for say 30th September, so you can utilize this option only on 30th September and not before that. So that is called as European option, while American is the one which you can exercise at any time before 30th September. Now in India, only European options are allowed by RBI. So we don't allow American option. And because American option allows you a greater flexibility that it can be exercised anytime, they are a bit more complex to value and also more pricier than the European option. So till now, in India, it is not allowed to do the American options. So we'll consider all the examples from the point of view that they are European options, which can be exercised only on the due date of the contract. Now we'll also go to some other basics, which are the moneyness of options. So why is this important? Because the more closer your strike price is to the current market, the premium will accordingly vary. So again, whenever you are doing an option, the counterparty, your bank or any exchange persons, your sub-broker may ask you, and your premium will change accordingly. So now first is the ATM, which is at the money. So ATM is the situation when the option strike price is same as market price. Suppose if you want to book a forward today for 2 months and your forward rate is coming at 83, and at the same time, if you are doing your option also at a strike rate of 83, that means you are doing an ATM option, which is at the money option. Now, the more you want, today, if you want to book a forward today, the rate is at 83. You want to book a rate in case of option, which is below 83, means you want to go more in the money. The in the money means you are going in more in your favor. So if you want to do a plain buy call, and your market rate is at 83 and you want to do a buy call at 80 to 75, then that option premium will be higher. It will be more costlier than the 83 rate. So buy call at 80 to 75 will be costlier than buy call at 83. Or buy call at 83.25 will be much cheaper than 83. So because you are moving the strike price in your favor, so the premium increases. So in this case of call option, if the strike price is below the market price, it means the option is in the money. So the more you move your option in the money, the strike price move more in the money, your premium keep increasing. Similarly for put option, because you have a right to sell at say 83 and you are asking that give me option to sell at 84, then you are asking a 1 rupee higher rate to sell your dollars, then the premium will increase. So when the strike price is above the market price in case of put option, that is called as in the money for put options, and it will be costlier than your normal at the money option. Just opposite to in the money, the other thing is called out of the money. So out of the money means in case of call option, if strike price is higher than market price. So if you are able to buy at 83 and you are ready to buy at 83.25, so means you are moving out of the current rate. You are moving away from the current rate. So in those cases, your premium will reduce. So you are taking a out of the money option, which allows you to reduce the premium. Similarly, in case of put option, your market is 83 and you are okay taking a strike at 82.50, then your premium for put option will reduce. So now this basic concept of moneyness is to understand that if you are not ready to pay a certain amount of premium for option, then you can move your strike price accordingly higher or lower, and decide what amount of option premium you are comfortable to pay off. So if you are okay paying higher, then it is, you can try and going in the money. If you don't want to pay too much premium, just want to lock certain rates, then you can go a bit out of the money and reduce your upfront premium payable. So that's why the moneyness of option is very important to, from the point that how much premium we are ready to pay, because it has to be paid upfront. It's a cash flow there. And of course, your costing and everything for a transaction will get affected depending on the how much premium you are paying for. Now, what are the factors affecting option premium? As the first one is the moneyness, which we already explained. So if it is, the more the strike price is in the money, more is the option premium. The more strike price move out of the money, the option premium reduces. That's already been explained in the previous slide. Time to maturity, as I said, the premium increases with the increase in time to maturity. So for option for a September will be cheaper than option for December or January. So, and vice versa. So the premium will increase. So as I said, premium as a component of intrinsic value and time value. So time value is increasing because we are increasing the maturity date. So premium is also increasing. Now the third point, current volatility is very important here. Suppose sometimes you are doing an option wherein the market rate, strike price, maturity date, everything is same, but market is very stable, where it is hardly moving 4-5 paisa in a day for 10-15 days. So your current volatility is very low. In those cases, option premium will be cheaper because then market participants are not doing so much options. No one is too much bothered about the sudden movements. Then no one is, so basically the demand for option is less in those scenarios. So at that time, the premium will be comparatively lower. It's not like forward where premium will always remain consistent if interest rates and everything remain low. But here, your option premium will change. Now, suddenly, if some event happens and the volatility increases, rupees start moving 40-50 paisa in a day, and every day in, day out, there is a large volatility in rupee. So current volatility is increased. So now for the same maturities, same strike price, everything, the premium will increase. Because now instead of forward, everyone would be looking to do a option here. So in those cases, suddenly the premium demand for that options have increased. So in those cases, the premium will suddenly rise. And this rise could be very big also. Sometimes in short term, there could be scenarios where premium could rise. Like if suppose the premium was 50 paisa per dollar, suddenly for same maturity, it could rise to 70, 80, or even 1 rupee, depending on the volatility, how volatile markets are. So this, again, for the premium component, current volatility is a very big factor there, which changes the premium every day. The fourth factor, interest, it doesn't move so frequently. Like it will move when generally there are change in the interest rates. So suppose in case of dollar rupee, whenever there is a Fed meeting, US Fed meeting or RBI meeting, and they make changes in the interest rates, or there are indication of changes in the interest rates, those time interest component will have an effect on. So that will also affect your forward premium, but also, and similarly also affect your option premiums here. So interest rate changes also affect premiums, option premium, but it's not so frequent compared to the current volatility and other factors. So these are the basic 4 scenarios which will affect your pricing. There are, in technical terms, there are various couple of other things also which changes the premium. Those are called option Greeks, but it's a bit too complex thing. So we have kept that out of the scenario right now, but those are basically 5 or 6 option Greeks are there which affect the premium. So those are delta, theta, gamma, rho, and vega and all. So basically those option Greeks are the major factors which affect your option pricing. For conceptual knowledge, these 4 factors are important for you to understand what can affect your pricing and why it is reducing or increasing day in, day out. Now moving ahead, these are the basic features of your options, plain vanilla options and everything. Now I'll run you through some examples of all the 4 scenarios and also explain you the basic risk and what are the payoffs for the option. First, I'll run you through a plain buy call. So now a buy call will be done generally by an importer So when you're doing a plain forward to cover your imports, you can also simultaneously look for doing a plain buy call here. So a buy call provides importers with protection against INR depreciation. And it also provides flexibility to capture on favorable moves in the currency pair. So we have taken an example. Suppose your USD is at 80 to 80. Now, if you would have done a forward for 3 months, you would have paid 30 paisa right now. So your rate gets logged at 83.10. Now, if rupee goes to 84, then you are happy at 83.10 because you had booked your imports at 83.10. But if suppose RBI intervenes sharply and rupee goes back to 82.50 or 82.20 or even below that, then you might feel that, okay, I should not have booked the forwards and I could have got this opportunity to capture on the better rates. So in this scenario where you feel rupee is already at a high level, but you don't want to keep your risk open, then you can probably look to do buy call here. So this current rates, current scenario here where the market is trading at 80 to 75, 80, this is a very good opportunity to do buy calls rather than doing plain forwards in case of inputs. Now, suppose if you would have done a buy call here at 80 to 83 months, option premium, which we have captured today, is coming to 75 paisa. So you are paying that 45 paisa extra to get the flexibility of the option. So if rupee closes, so what are the scenarios? So if it is at 83.10, forward may you get 83.10. Now, if you do a buy call and INR closes above 80 to 80, so suppose if it goes to 84 or 85, the company will be buying at 80 to 80 because you have done your option at 80 to 80. So wherever market goes above 80 to 80, the buyer of the option or the company who has done the buy call has the right to exercise this option, and you will buy your dollars at 80 to 80, despite market being at 83, 84, 85, wherever. And you will buy your dollars at 80 to 80. And your cost is basically the 75 paisa which you have paid. So that extra cost, of course, will be you have to take into consideration while taking the effective rate, but that is already paid upfront. While when your final payment happen, it will be done at 80 to 80. So if rupee is at say 80 to 80 plus 75 paisa, which is 83.55. So if rupee moves above 83.55, then you are anyway better off than, even if by paying the premium, you are still at a better effective rate of 83.55 if rupee goes to 84. Now, if rupee goes to 82 or 81.80, which we had seen just 10, 15 days back, that rupee went to 81.67, 81.70. If rupee moves to 81.70 in next 3 months, then you don't have an obligation here to access this particular option. You can just leave the option. You have paid your premium already, and you will buy from the market rate. So market is at 81.70. You will buy your dollars at 81.70 from the market, and the effective cost will be 81.80 plus 75 paisa, which you have already paid upfront. So still you are better than the forward rate, which you would have get logged at 83.10. So of course, this is a bit costly, you can say, paying extra 45 paisa premium, but it is also providing you flexibility if rupee moves to 81.80 or something. And as I said, in the current scenario, when market is looking at, you can see RBI intervening sharply at 80 to 85, 90 levels. So there is a good likelihood that once this pressure of outflows, whichever is happening, goes off, rupee can quickly move to 82, 81, 80 kind of level. So it is better in this scenario to probably look, rather than just keeping your risk open, you should better go to do buy calls rather than doing the forwards. So if you are okay doing forward, I would suggest you pay a bit more and do a plain buy call here, which will provide you the flexibility also if rupee moves in your favor. So at this rate, you might just get locked at a very high rate. So plain options, the plain buy calls can provide you a better opportunity here. So this is about the buy calls, which is basically for importers. Now we'll move to a scenario where an exporter want to sell dollars. So just like the plain buy calls, these are also premium paying structure because you're taking a right. So it is also a premium paying structure. So now an exporter who want to book a forward, he will generally receive the premium along with the forward rate. So for an exporter, this is a bit tricky situation where instead of receiving the premium, you are paying the premium here. But then in case of large moves, sometime doing a plain buy puts also can help. If suddenly rupee weakens sharply, like it happened during the Russia-Ukraine war and in last whole year when rupee weakened sharply from 74 to 80 and then suddenly after 80 broke to 83 and all. So in those scenarios, sometimes doing plain buy puts can help exporter also. So that will basically safeguard against your appreciation. So if suddenly rupee starts moving towards 81, 82 or below 81 or something like that, then this buy put will allow you the safeguard against that. While at the same time, if rupee moves to 84 or towards 83, 50, 84, 84, 50, then it will also allow you the participation here. So I'll run you through an example here. If you do a buy put at 80 to 80, maturity 3 months, forward you would have logged at 83.10, while in case of buy put, you are paying a premium of 50 paisa here. So if INR closes below 80 to 80, anywhere, suppose at 82, 81, 80, 81, 50, wherever rupee appreciates, you will still sell your dollars at 80 to 80. So that is the, like a plain forward, you are locking yourself at 80 to 80. But if rupee moves in your favor, if rupee moves to 84 or 80 towards 84.50 or something, which is a likelihood because suppose if 83.30, around 83.30 was the all-time low for rupee. If that breaks, suddenly there could be some panic buying by importers, traders, and everyone, and rupee moves to say 84, 84.50. So in that scenario, you will not, in case of forward, you would have just got logged at 83.10, but buy put will allow you that flexibility. So if rupee moves to 84, you will not exercise your option. You will go and sell your dollars in the forward in the spot market at 84, while just foregoing the premium of 50 paisa which you already paid upfront. So this way your buy put will allow you the flexibility if rupee moves, depreciates in your favor for an exporter, and if it moves lower, then you are locked at 80 to 80. Now this is also a premium paying structure and similar to buy call. And as these are European options, this you need to exercise only on the maturity dates. Now moving ahead, we'll move on the other side of the option. So generally, when you are doing a buy option, there is a counterparty who is doing the sell on the other side. So when you did a buy call, there is someone who is doing a sell call. In your case, generally, if you're doing with an exchange or a bank, it will be the other parties who will take that risk. But then there are corporates who also want to do options on the other side. So someone has done a buy call and paid premium and safeguarded themselves. But if you want to explore the other side, we are running you through these examples also. So now because, so if you see a sell call, there's the counterparty on the other side, which has done a buy call, which is paying the premium. So the seller of the call option will be receiving the premium. So suppose I pay in the previous example, buy call, when I did buy call, the buyer of the option paid 75 paisa. So the person who has done the sell call will receive that 75 paisa. So the advantage here for the sell call is if rupee doesn't move or the counterparty doesn't exercise his buy call, then the seller of the call option will earn the 75 paisa and that will be his profit entirely. So that is the benefit of the sell call. But now risk in this case is unlimited. If rupee keeps depreciating to say 85, 86 levels, so the buyer of the call option will exercise the right of buying at 82, while the seller of the call option will have to buy sell the dollars. So someone is buying, so the seller will be selling the dollars here. So he has to sell his dollars at 82, while rupee is trading at 84 or 85 level. So that that loss will happen to the seller of the call option, and which is unlimited. If rupee keeps depreciating one way to 85, 9 or 90 or even also, then also the risk is open for the seller of the call option. So there's a unlimited risk, as it pointed out, that it's an unlimited risk of INR depreciation. So generally traders or people who think that rupee will either stay flat or will appreciate from here, then they will do a sell call to earn this extra 75 paisa. So generally it is done by traders and people who want to earn extra money there. And their view is that rupee may not weaken so much. Now, the example here which says 80 to 80 So if, as I said already, the buyer of the option will exercise at 80 to 80 if rupee goes to 84, and the seller of the option will have to sell dollars at 80 to 80 despite market being at higher rate. And rupee keeps depreciating, the loss to the seller of the option is unlimited. So the only advantage for this seller of the option is when market stays flat or it appreciates. Now, moving to the next, sell put. So when someone had done a buy put here, the counterparty had done a structure of sell put. So the buy put person has paid a premium of 50 paisa. The seller has earned that 50 paisa, seller of the option. So it is a premium earning structure. But here, the risk is of INR appreciation. So someone has taken a buy call at 80 to 80 and rupee appreciates to 81 or 80 levels. So the buyer of the call option will exercise his right and sell his dollars at 80 to 80. Now, market is at 81 levels and the counterparty, the buyer of the option is selling at 80 to 80. So the person here who has done a sell put will need to buy the dollars at 80 to 80. So market is at 81 and this person, this person is buying the dollars at 80 to 80. So that is a loss to him, that 1 rupee 80 paisa. So this loss can be unlimited. If rupee keeps appreciating to 80 level, 78 level everywhere, this particular person who has done a sell put will have no choice but to oblige whenever the buyer of the option exercise the right. That's why it is said if rupee keeps appreciating one way, the loss to the seller of the option is unlimited. Again, the person who is doing a sell put will only benefit if rupee stays flat or rupee weakens. Then the buyer of the option will not exercise his right, and this guy will earn the 50 paisa which he has earned initially while doing the sell put. Now, these were the 4 combinations of buy call, buy put, sell call, and sell put, which are called as generally buy call and buy put are termed as plain vanilla options. Now, all the other strategies which happen in the options market, in the currency market, are combination of all these 4 structures. So, whatever strategies we had run you through in the last webinar, or which can be explored by you, or your banks can come up to you giving you various strategies, they will generally be a combination of all these 4 option structures only. Say suppose they are saying it's a range forward, so a buy put sell call combination becomes a range forward for an exporter, and if you talk about an importer, then buy call sell put becomes a range forward for an importer. If you do a buy call and sell call together, it becomes a call spread. If you do a buy put sell put together, it becomes a put spread. If you add 3 structures together, it will become a seagull. If you do so, that way there are various combinations of this 4 thing only. We can keep doing, adding multiple options, and it will form different strategies. And of course, the names are also different depending on the strike rate. These are called straddles, strangles, seagulls. Everything is basically a combination of these 4: buy put, buy call, sell put, and sell call. So if once you are clear about all these 4 conceptually, these 4 particular scenarios, then all other options can be broken down into this level, and you can understand the payoff for other strategies also. Now for corporate, as I already told, there are 2 markets for dealing in options: OTC, which is your bank, and the exchanges. Here I put a snapshot of NSE. So the left side gives you calls. This is for August and maturity. And the right side gives you price for puts. So the LTP, if you can see, it is the last traded price. So when we were talking of moneyness of an option, so say current rate is trading around 80 to 75, 80. So the more your buy calls, the more you move higher towards 83.50, 84, lower if you see the lower levels, and you see the last traded price LTP that is reducing. So the more you are moving away from your current market rate, your premium option premium reduces, and the more you move in your favor on the upside, the premium increases. So this is the moneyness of the option, where if you are taking a strike rate, market is at 82.80 and you are taking an option buy call of 82.50, it will cost you 50 paisa. If you further go in and take a buy call of 82, premium is 92 paisa per dollar. While if you go and do a buy call of 84, it is just 2 paisa. Or if you do for 83.50, it is just 7 paisa. But then the rate of 83.50 will be protected and not the current rate. So the way you change your strike rate here, based on that, your premium changes. So the left-hand side is basically for calls. Similarly, the right-hand side is for your put options. Now put option, the more you go up towards 83, 84, your last traded price, you can see it is increasing. So the option premiums are increasing as you move towards 83, 84, 84.50 level, while it is reducing on the lower side. So if you see rupee moving, if you see your strike rate at 81, your premium is hardly less than 1 paisa. If you see 82, your premium is 3 paisa for buy put. While if you take a case of buy put at 84, your premium is 1 rupee 15 paisa. So this is the basically explaining you the moneyness of the option, and also showing you the live screen of basically the snapshot of the live screen of your NSE platform, where you can see all the pricing for different strike rates. You can change, and you can also change your maturity dates, and accordingly the option premium will change. So this is the snapshot of NSE, and so now where Greenback can add value is when, so now these options are not other than NSE. If you want to do your options on OTC market with your bank, basically authorized dealers, then your options are not quoted anywhere like in case of forward market. So forward market are just quoted up to 12 months, and you can see those forward rates and check the spot rate and book your forward. But in case of option, they are not quoted anywhere. It is computed on a specific platforms, and it will also change based on your strike price and all. So Greenback have capabilities to price this option. We can help you in securing correct pricing, negotiating with the bank, and whether in this current scenario these are appropriate strategies to do this structure or not. Everything, when to enter, when to exit, and if you are already entered into the structure, how to monitor it, when to take the stop loss on the position. If you have done suppose if you do a sell call or sell put, then there is an unlimited risk. So when to exit from this position, all those things can be done by Greenback. We also do hedge accounting for corporates, where we can also help you on the accounting of the option premium as all. And we can do MIS and dashboard for tracking the various option strategies. So this is the way where Greenback can add value if you do enter into the markets of options. Now, I'll be happy to have some questions. You will have your Q&A thing there. You can put your questions there, and I'll be happy to answer. Right. Anything from your side? Please put in the Q&A window.
Yeah. So we have few questions coming in. So we'll answer one by one. So Hina is asking, how do you calculate premium of option with time decay?
And the another question is how the premium is calculated from Mr. Sanjay.
Yeah.
So any kind of option, basically it's time decay, as in if you're talking of basically what is the time to maturity, if I understand it correct. So you don't, so any computation first for your option is a very complex calculation. It's generally done through a Black and Scholes model, and it requires specific software to do. It is not a easy calculation. You can't run it through on an Excel or something. It needs a lot. It needs a lot of computation and a lot of variables there. Your current walls, which are trading in market, you don't have access to that. Those are input there, and all the current rates, current interest. So as I said, there are option Greeks, which involves delta, which is how much your option premium changes by the change in the underlying. That is delta. So there are all those Greeks, delta, gamma, how much your delta changes with the change in the price of the premium. Then there is theta, which is called as time to maturity. Rho is the change in the interest rates, and vega is the change in the volatility. So all those Greeks are involved. It's a large computation. So it's basically, you can say it's a big software which will generally do a lot of computations and compute the option premium, which is not computed directly on an Excel. So that way, you have to run through a large model there. You can find nice online theories if you want on the Black and Scholes model and all for the option pricing there. So it's generally done through software, specific software in India, generally Bloomberg, Reuters, and then there's a couple of more outside platform which will generally do option pricing on those softwares. Anything else?
So we
And
have
time decay, sorry to add to that. So as I said also, if the time to maturity increases, your option premium will increase. So if you do an option plain buy call for September, as we said, 3 month, the premium is 75%. If you do a buy call for December, your premium would be probably 1 rupee 20 paisa or something. So the more longer you go ahead, and then the more higher the premium of the option. Yeah. So Piyush Kamath is asking a question on the swap. Basically, it's not related to options, but can we do restructure of forward contract in case of restructuring of original underlying liability? So generally, in case of swaps, sir, basically, if I'm not wrong, in case of when transitioning happened, that time this restructuring was allowed. But most likely, generally, if you have done a swap and you have cancelled that swap, then you cannot rebook it. But you cannot rebook against the same underlying the swaps. So that is something though we'll need to check again. You can probably connect us separately, and we can explore. And we'll also have to check with the banks. But generally, it was as per RBI guideline, if you cancel a swap against a particular underlying, then you cannot re-enter into those swaps.
Yeah.
Yeah. So
next, we have Nishant Kothari asking, will it be correct to interpret that hedging through options would be beneficial generally in cases where market is volatile because of the premium differential between forwards and options?
So yes and no both, because it won't be generally beneficial to you because your option premium will be higher. Or in those cases, if suppose volatility is high, then option premium will shoot up. So suppose if forward premium is 30 paisa for a certain maturity and your option premium is 50 paisa, and suddenly large volatility happens in next 3-4 days, then that option premium of 50 paisa can even go to 70 paisa, 80 paisa, or to 1 rupee. So as the volatility increases, the premium will increase. So in those conditions, you might just feel that option is too costly to be done. But you can say you will have to see a scenario where now you have to also take into consideration the basic view here. If rupee is say right now at 80 to 80, and your policy says that you have to hedge your imports in this particular week itself, example. So now you have no choice but to book your you hedge your imports at 80 to 80. So if you book a forward, you get logged at 80 to 80 plus 80 the time. So in this kind of scenario, you can do buy calls, plain buy calls, paying an extra premium because there is a good chance that rupee could appreciate to 81, 80, 82 levels again. And that moment, this option will help you. So if there is a one-way movement has already happened, and then you feel now the movement is overdone, and now there is a chance of reversal. In those scenarios, you can do the option. So similarly for the export, if sudden there is a large appreciation has already happened, and then you feel that though you don't want to risk rupee going further lower, but you feel there could be a reversal back, then you can do buy puts in those cases. Or or generally option will be beneficial, or generally they are preferred ahead of some you can say some event is going to happen. Suppose there is a FOMC policy is going, a US Fed monetary policy meeting is going to happen, and there is a expectation there could be a large hike of 50 basis point or something, and it doesn't happen. So before that, or if there is a general election coming, and or a Indian Union budget is coming, after that you don't know. You feel that market may move large by say 1 rupee or 2 rupees on either side, but you are not sure which way market will move. In those scenarios, options will be beneficial rather than forwards. So you'll have to take case to case in which scenario, which options are better. But generally, ahead of events where you expect large movements, those time options are beneficial. Or if market has already moved too much in your against you, and you feel there is a good chance of reversal, but you don't want to take risk, those time options are better. I hope I answered your question.
Yeah. So now we have Hina asking that is our understanding correct in saying that in options our loss is limited to our premium amount and profit is unlimited?
Yes. So if you do a plain, if you're doing on the buy side, if you're doing a buy call or buy put, your understanding is correct that your option is loss is limited to only the premium which you already paid, and the profit is unlimited. So if you're in your case, suppose if you are an exporter and you are sold at 80 to 50 and paid a premium of 50 paisa, rupee goes to 84, 85, whatever, your profit is unlimited and your loss is only to the extent of 50 paisa what you have paid the premium. But if you are doing a structure on the other side, if you are doing a sell call or sell put, then this doesn't work out this way. Your loss can be unlimited. So only in case of buy put and buy call, your understanding is correct that the loss is limited to option premium and profits are unlimited. Okay. Anything else?
Do you have any more questions? Okay. So thanks, Jailesh. I think now participants would be able to take advantage of this and would broad base their hedging with options, having a clear understanding on the basics.
Okay, thank you so much. Thank you everyone for coming. And if anything required, you can always mail. My ID is displayed here. You can send in your queries and we'll be happy to help you case to case basis, and we'll connect with you for any of your queries. And thank you everyone for coming here and joining us for this webinar.